Hello, everybody, and welcome to this Q3 presentation of Hafnia. My name is Q&As. I'm with HCA, and I'll be today's moderator. With me today, I'm happy to introduce to you Perry van Echtelt, the CFO, and Søren Steenberg, Head of Asset Management. Welcome to you. Nice to see you.
Thank you very much.
And for the
Thank you very much. Thanks for having me.
Yeah, nice to see you. We'll take about 30 minutes of your time to walk you through Q3, many interesting events, and of course a lot of discussion about geopolitics, but we'll get back to that. We'll do it in two parts. Basically, Perry will cover a lot of the financial stuff, and then Søren will cover some of the market stuff. And please, if you have any questions, put them in the chat. We'll make sure that they are all taken one by one. But Perry, over to you, and perhaps a brief introduction of Hafnia. We always start with that, please.
Yeah, thank you very much. For the ones that haven't been in these calls before, quick update and introduction on Hafnia. Hafnia is a 15-year-old company. We are a shipping company that is active in the product tanker and the chemical markets. We have a fleet of 117 owned vessels and 9 long-term time chartered in, so that brings our fleet to 126 ships across the various segments, so from handy size to MR, LR1 and LR2. And in the MR and handy sizes, we have a mix of product tankers and chemical tankers. It's one of the most diversified fleets that's around. We have a very modern fleet with an average age of 9.6 years across the owned vessels. It's a global commercial platform, so we operate globally. We have an in-house dedicated technical management team that is managing roughly half of the fleet, and the rest is externally managed, which gives us a good balance and good benchmarking on how we operate our ships. In addition to the ownership of our vessels, we also run an adjacent business, which is the commercial pools, where ship owners that want to tap in basically into the scale that we have join our pools. We run a total of 8 commercial pools where we have 80 ships, so in total well over 200 ships that we run globally across these segments. Also in the bunkering space, we are very active. We started out with our own bunkering team that provided bunkering services for our own fleet, then for the pools. And it has grown quite rapidly, and that led in May this year to join up forces with Cargill and creating the Seascale Energy bunkering joint venture. Next to that, we're quite active also on innovation, but we'll talk a little bit later when Søren is going through that. So a worldwide business with strong scale towards our clients. Therefore, we can also operate a low-cost business. We run, if we look at an OPEX and G&A combined, an industry-low business in terms of costs. We also have a strong focus on shareholder distributions. That means that if you see the middle right part of this page, we connect the strength of the balance sheet to the payout ratio in terms of how much we pay on a quarterly basis in dividends. So we started out when we did an IPO in Oslo in 2019, and by now we're listed both on the Oslo Stock Exchange and the New York Stock Exchange. Depending on where we are in terms of loan to value, being the debt that we have on the 100% owned ships versus the market value of those ships defines how much we're paying in terms of dividends. We're currently in a bracket of 20 to 30%. That means that 80% of our net profit is distributed to our shareholders. It's a very clear and a transparent way for investors and analysts to take a perspective on the earnings and the dividend capacity of the company. We've paid dividends over the last 15 quarters and $1.16 per share for 2024. Then a little bit more on strategy. I said we're a relatively young company, but we have a very active mindset towards strategy. We can do transactions where growth makes sense for the business, whether it is acquiring ships, doing new buildings, or doing joint ventures or M&A. Just as an example, on the right side here on the page, In 2018, we set up a joint venture called Vista together with CSSC, where we now own 10 vessels, 6 LR1s that we ordered in, if I'm correct, 2017, but also 4 dual fuel LNG vessels that we have on longer term time charter. The acquisitions in 2022 were even more transformational for Hafnia. We acquired Chemical Tankers Inc., which is a fleet of 32 chemical tankers in the Handy and MR sizes, where Oaktree was the dominant shareholder, and we did a transaction there on basically a NAV to NAV shares where they became a shareholder. At the same time, we acquired 12 LR1s from Scorpio, and that also at the start of a quite strong market in the years after was an important strategic transaction to us. Looking at what we did after was another new build transaction together with Socatra from France called Ecomar, where we have 4 methanol dual fuel MR vessels. 3 of them have already been delivered. The next one will be delivered in early next year. The Seascale joint venture I had already mentioned. So that's a quick introduction on Hafnia. We can, yeah.
Thank you, Perry. I think let's go into Q3 a little bit. And
so
let's take this slide as the starting point, please.
Yes, thank you. We have a bit more on financials later. We can get into it, but I think the key is here. Q3 highlights, we released financial results yesterday. Typically Q3, if you look at seasonality in product tankers, Q3 is a weaker quarter because it's basically in between what it was coming out of the summer heading up towards a stronger winter market. So typically Q3 is the weaker quarter, Q4, Q1 in the winter the strongest, with basically a flow out into Q2 as well. But we saw this quarter that for various reasons that there was a strong market. There were more ton miles in the market. There were more vessels that had been sanctioned in the fleet, leading to tighter supply. So that led to a TCE income of $247 million. We have also the fee business that I mentioned. That is where we have a fixed fee per day and a percentage of the TCE. Realized $7 million of other operating income, and that leads to an adjusted EBITDA of $150.5 million and close to $410 million for the first 3 quarters of the year. Then boiling down to net profit, we made a profit of $91.5 or $18 per share. And given the dividend policy that I just explained, that means that we pay out 80% of net profit, being $73.2 million or 14.7 cents per share. Sorry, Tui.
Yeah, Perry, just of course, it's also very important that
I'm losing.
Yeah, let's give Tui just a minute to come back online.
Yeah. Otherwise, just to complete on what we have here, we also, as part of our modernization of our fleet, we sold 4 older MRs. 3 of them will be delivered and recognized in the fourth quarter, and 1 was recognized in the current quarter. Tui, are you?
Yeah, sorry, I'm back. It was the Torm thing you did in September. Maybe you can just explain a little bit about that. I think there will be many questions about that, please.
Yeah, I can imagine that there are questions on that. There's also, I have to say, to start off, that there's a limit what we can say about it. But indeed, in September, we announced that we came to a preliminary agreement with Oaktree to buy 14.1 million Torm shares. That was soon resulted into a binding purchase agreement. There's a few conditions that are outstanding that need to be fulfilled. The last one being the appointment of a new independent board chair, and then we can close that transaction. We can't really comment on when that is going to happen. Reason for that transaction in itself was we deem it as Torm is a well-run company. There was an opportunity to buy this stake. And as I alluded to earlier in the introduction, we continue to look at transactions that make sense for the company and especially also for the shareholders, which led to us ultimately concluding that transaction.
And I'll just change to this slide because it also has implication for your LTV and stuff like that. But maybe you can explain how you're thinking about your LTV in this, because you could assume that you went to the 90% level if you're not including the TORM shares. Am I right about that?
Yes, absolutely. And that's why also after the announcement of the intended share purchase that we updated our dividend policy, where we focus on the debt on our 100% owned vessels against the market value. But that also means that with a substantial investment like this, which is basically also exposure to the product tanker market, that we decided to include the financial investment of TORM in the net LTV calculation. So that means that we take either the purchase price or if it will be lower, the market value of that stake being added to the fair market value of the fleet. But then obviously also our debt goes up because we use our available resources in terms of cash and financing to calculate that. So you're absolutely right that once that transaction concludes, that would impact our LTV going up.
Yeah, because I heard some confusion yesterday about this. Some analysts may be confusing that you could go to the 90% level in Q4, but in reality, it's more likely that you stay in the 80% level.
Yeah, so that indeed it will be depending on when it closes. But as we want to be very transparent on our distribution to shareholders, we updated that dividend policy early when we announced that transaction to make sure that everybody knows how we're taking that into account in terms of the dividend policy.
And although I respect that you cannot comment entirely, what is the next here? You're talking about a sort of potential, they need to announce a new chairman, as I understand it, in TORM for you to proceed with closing of this. Is that what we are waiting for?
Yes, that's the outstanding condition to the transaction.
Okay.
And then, otherwise, I think it created attention, to put it that way. So analysts and media have taken their perspective on what that would mean.
Okay, cool. Being in the financials section, we also have to touch upon your coverage for Q4, but also into Q1 perhaps. Could you elaborate a little bit about that?
Yeah. So, and we announced as of mid-November, so the 14th of November, that we had booked 71% of our bookings, which is basically in line with where we are in the quarter. That also means that we probably talk a little bit more about the market going forward, but that shows an improvement of rates. If we look at where the market is now, we are close to the 26,040, 25,600 in terms of what we have booked for the quarter so far. Q3, I hadn't mentioned that yet. That was quite impacted by our dry docking schedule. We have a lot of ships, especially the chemical tankers that were delivered from new in 2015. So that means that we have quite a few ships that go for their dry docking in this year. We have over 40 ships. The bulk of that has already happened. But the chemical tankers are a bit more complicated, depending on whether a recoating is necessary or not. So therefore, we had 230 extra dry docking days in the quarter. But if you look at the graph on the right side, you will see that tapering off in the current quarter and further reduces in 2026. We still have, I think, 28 ships that go into dry dock, but these dry docks are shorter than what you would typically see for the chemical tankers, which you can see in the red or burgundy part of this graph.
And just to make sure, Perry, this is really common. This is normal levels of coverage, but also your dry docking plans for 26 has not changed overall.
No, there's every 5 years you do a special survey in terms of dry docking for the vessels that is necessary. There's not really something that you can plan away from that. So this is all following the age of the vessels and the dry docking schedule that they require.
And perhaps a few words on this one also, with the analyst consensus and the optimism that you see in the market about the winter market. Perhaps a few words on this.
Yeah, so if you look at, we always put this page in our investor presentation. It's not necessarily a forecast, but we show basically the bandwidth of what we see in the market, of what we have already covered. So the bottom part of the right side of this page shows EBITDA and income if you just extrapolate what we had already booked for the quarter. The top end of the side is the analyst consensus, where they also take in they take in their own rates and perspective on profitability, and perhaps also a little bit more on the end run of the quarter in the year.
Yeah. So I think this is an excellent slide. Actually, people can get an overview of what is the expectations in the market. So it's very easy to understand. And if you have any questions to this, let us know. But with that, Ferry, I think we'll conclude the finance section and maybe talk to you, Søren, a little bit about the current turmoil in the geopolitics. Maybe starting off with explaining a little bit about, I think there's 4 themes. Basically, we read in the papers that the Red Sea is opening up again. And maybe we can start by that and give a few comments on that from your side, please.
Yeah, so the Red Sea, of course, have not been completely closed. There's still a lot of traffic going through, but predominantly through especially tankers, where we have the ultra flammable explosive cargos that we sail with. It has been a no-go. Generally, there are more people looking into this now. We hear some of the container owners are looking into it, although not doing it yet. Generally, we are waiting for a more, I would say, long-term truth or long-term proof that essentially that our crew are safe to sail through on the ships. I think that when we see a pickup, that would, if and when, that would most likely be started by bulker traffic and container traffic. And then as we see that they are transiting safely, then we will consider whether there's a possibility for the tankers. So I don't think tankers will be a first mover when you start seeing traffic returning to the Red Sea.
And so, and perhaps just expanding on this, will this be an advantage for Hafnia, or will it be neutral or a disadvantage?
Yeah, we have a slide on this in the deck, but generally, I think that a lot of people think it will be a disadvantage. So I think initially when the Red Sea closed, we saw a lot of traffic being redirected via the Good Hope. That added a lot of cost to the delivered barrel in the Western Hemisphere, which over the next coming months and quarters basically meant that we saw the volume reduce, simply because especially the US have been very strong at picking up and being the more competitive barrel. So what we essentially saw was that the Western Hemisphere became more of an eternal market, where the US Gulf supplied Europe and West Africa and South America. And that has also been part of some of the other dynamics that we have seen that has strengthened that area. But overall, when it comes to east-west traffic, i.e. cargoes going from the Middle East and India to the Western Hemisphere, it actually net meant that we saw less traffic going that way. So we lost a lot of arbitrage barrels because they were not competitive. So what we are arguing is that if we see the current traffic that is going via the Good Hope now going to the back to the Red Sea, we would have lost some capacity. But if we actually add the barrels, the trading barrels that we lost, we are almost back at a net zero. So for us, we think if there is a negative impact on the market, it would most likely only be a sentiment that because it's expected to have a negative influence, whereas from a trading perspective, the math shows that it should resume to a relative normal market without big impact. But as I said, there's a slide later on where we've illustrated that.
Yeah, and while at that, I think we have two other things that's really on people's agenda or investors' agenda, and that is, of course, peace in Ukraine and the large shadow fleet of the Russian that is used for producing or transporting Russian oil. Could you comment on Hafnia's position on that? I know it's difficult, but I think it's on investors' minds anyway.
Yeah, I would say between the Red Sea and Ukraine, and then now Venezuela entering the picture as well, it's not exactly easy to do these these projections. But generally, we have about, I would say, 61 million deadweight of over 20-year-old tonnage that are still sailing with Russian oil, which essentially in a normal world would have no license to trade. They are overage, and we do expect that on a normalization that they would exit. Then we also have to take into consideration that Europe will most likely not return to a picture where we become fully dependent on Russian diesel again, or gas. So some of that will have to sail longer distances, because Europe is not going to be the almost exclusive import of that. So I think there will be a new mix that we will see simply from energy security policies as well. A combination of ships that will permanently exit the market with longer trading distances, as Europe will try to secure some of their imports from Middle East and the US, and not be totally dependent on Russia. So I think that the one thing we can say is we do not expect it to return to where it was before the war, and some of the dynamics will probably dampen the effect of some of the barrels sailing a shorter distance from Russia into Europe.
Okay, and touching upon Venezuela, that's a new thing. It hasn't been a theme for quite some time, but what's the status on that seen from the Hafnia perspective?
The status is let's wait and see. I think that Venezuela was down to a very few compatriot countries that they traded with, and we simply have to wait and see if this rattling with the sables ends up having an effect. But of course they have picked up. If you go back 2-3 years, the volumes that everybody was saying that they were being smothered slowly. Lack of spare parts, lack of technology, lack of expertise meant that their export volumes were severely down. But they have actually recovered meaningfully over the last 2-3 years. So they certainly have barrels to be a factor.
Okay, and perhaps touching upon the winter market, because normally we get a strong market into these months. Can you perhaps touch upon that? And I think we see some sign of it is actually quite strong. Maybe you can talk us through your thinking about the winter market coming up.
Absolutely, which is very much sort of a continuation of the factors that actually made Q3 uncharacteristically strong. So one of them is of course, if we look at the fleet addition, a lot of people, analysts, estimated that we would see a 5% addition this year. We all knew that the new build list was very, very heavy on the LR2 side, and you can say historically from 2017 up till today, about 70 to 75%, it's actually 72.5 precisely, ends up going into Aframax trade. So what we have seen is that with the dirty markets having improved a lot over the last couple of months, but also during the year with a lot of older Aframaxes aging severely, we have almost seen 88% going into to dirty trades, which means that we are when we did this material, we were down to about 0.5% fleet addition into product tankers in 2025. And by the end of, you can say, yesterday, we were probably at 0, because it looks like that the remaining units are also continuing that trend for the rest of the year. So one was the fleet addition. We almost saw 0 fleet addition. At the same time, what we talked about earlier, we have seen a very strong Western Hemisphere market that has also been fueled by refinery closures. So we have seen Immingham, we have seen Gelsenkirchen, we saw one in Scotland as well. So Europe continues to close down refineries, and those barrels have to be supplied from the Middle East or the US. And this year, especially the US, have supplied a lot of that. But we also saw towards the end of the quarter and into Q4 here, we also saw the Dangote refinery basically having to shut down their refining column for 5-6 weeks. And that also meant that US had to supply West Africa. So it meant that we had a very tight tonnage situation in the Western Hemisphere. And actually, when we look into Q1, we see very strong crack spreads still supporting that trend. And then, of course, US couldn't supply all this. So although that the Far Eastern Hemisphere initially in Q3 looked like the ARB was supporting more a Far Eastern supply out of the Middle East, because of these shortcomings in Europe, they actually started sending more and more cargoes to the West, which also meant longer voyages and higher demand for tonnage. And then lastly, maybe just an addition to the dirty fleet scenario is that we came from historically always having sort of a 5% cannibalization from the dirty fleet. Of course, with the high earnings that they are looking at now, they are drawing in all the new builds or the new build equivalents into their segment, but also means that we have seen hardly any cannibalization into the CVP segments. So all in all, a little bit of a perfect storm, you can say.
That sounds good for earnings. Let's take a few questions here in the end that we haven't covered. So the order book, there's a question from the audience here. Why has the order book fallen in Q3? Is scrapping increasing?
I don't think scrapping is increasing in any sort of very significant levels. I think why the order book has fallen.
I don't know if it's, but that's at least the question. But let's just continue.
But I think I think I would assume that it's the fact that a lot of these have gone into dirty. So for us in products, we have seen very little fleet addition.
Yes. Disposals of older vessels. I guess your average fleet is pretty young compared to competitors, but can you share with us this thinking about your fleet renewal schemes?
Yeah, so I think I mean it has been on our strategy since 2023 to life extend vessels. I think we a combination of what to build when we had arguably more pressure or interest, I would say, into alternative fuels. If we look back a year and a half ago, that has tapered off. And then also because of already back in 2024, we saw some of the highest prices out of the shipyards, almost historically high, close to. So I think that we said, okay, we are opportunity driven. We are not going to go out and order a large bunch of vessels in a very high cycle. So rather focus on extending the life of the quality tonnage that we have. And then maybe buy ourselves a little bit more time for some more opportunities to arise. And those opportunities may not be new builds. They could also be resales. It could be fleet purchases. It could be M&A. As you can see from history, used to
What
like
you're doing.
to mix and match where we find pockets of opportunities. But that being said, I think we have to look at all of them, because we could potentially enter a scenario where we're a little bit between a rock and a hard place, that the fleet is getting older and there's continued high activity at the shipyards. So prices are not falling meaningfully before we see the fleet aging even further. So an interesting place to be.
An interesting place to be. Perry and Søren, thank you very much for being with us today. I hope that people got an impression of where Hafnia is today. And if you have any more questions or things you want to share, please call us or the investor relations in Hafnia. Thank you very much. Thank you for now.
Thank you for having us.